You have entered as an attendee in listen-only mode.
Okay, good afternoon, everybody. I'm Ralph DeCesar, Head of Research, TD Asset Management, Board Member of FIAZI. This is our video conference that features Bloomberg Intelligence. This is actually the third time we've done something with Bloomberg Intelligence. Just a few housekeeping items. You should have a control panel on your screen where you could type in your questions. Please do so. Joel will get to those questions. He'll collect them throughout the presentation. Also, please note that we are recording this event. All comments are made off the record, may not be quoted. If you are a reporter, all comments should be cleared by Bloomberg before you reference them in the media. So let's move along. I want to introduce Joel Evington, Head of Research at Bloomberg Intelligence. I always admired what they do. It's nicely available right there on the Bloomberg screen. I always equate Bloomberg to Microsoft Excel. You are only using a fraction of it. And there is so much more there for you that's available. And once you learn those new things, your workday becomes so much more efficient and you become so much smarter for it. So it's worth delving into it. And so you're doing the right thing by being on this broadcast today. So I'm going to hand it over to Joel, and he's going to take over right now. Joel, thanks.
All right, thanks so much, Ralph. Lauren, if you could put the slides up, that would be great. And let me also thank all my fellow members of FIAZI and other guests that have joined us today. It's been close to 6 years since the FIAZI folks have added Mike Bloomberg into its Hall of Fame. As Ralph mentioned, we've done 3 deep dives into BI credit and how credit analysts and portfolio managers can best utilize the terminal. And I'm happy to say that the terminal continues to extend its many capabilities for us credit professionals. You will see the efforts our research and engineering teams have done over the years to further extend our leadership over the past couple of years. Lauren, next slide, please. Just a touch on Bloomberg Intelligence, or BI as most people call us. We now have over 350 professionals globally, supported by more than 500 third-party data sets to provide clients with fully transparent, independent insights into strategy, equity, credit, government, and litigation. Although not specifically shown there because it's embedded in both equity and credit, I should also highlight we have a full ESG team as well. The 37 members of the credit team will cover more than 500 issuers by year end, with plans to double that over the next 3 years. One of the great advantages we have at BI is that we can deliver our research via the terminal. So all of the cool charts and tools that you'll see today and that are on the terminal can be downloaded by you, our clients, for your own use. Another great feature within our department is the ability to collaborate, much like today where our strategy team is teaming up with us. As an industrial analyst, I don't have to guess, for example, what 3M's PFAS liabilities may be. I can work with our litigation experts to get their views and then use their views and model that into our credit model and scenario analysis to help frame that damage to the bonds for you, our clients. Next slide, please. All right, so let me take you into today's agenda. We've bucketed it into 3 basic categories. First, we'll have the BI credit analysts talk to the functions that they utilize frequently on the terminal using real-world examples. After that, we'll jump into our research. Noel Hebert and Ira Jersey will start with their macro views, giving us a framework for how to think about rates and credit in 2021. And from there, our credit team will dive back in with views on topical names and themes and how they're thinking about relative value. So with that, why don't we turn to the next slide. All right, so let's begin with our roundtable on terminal functionality. The many functions that you'll see today and that are being discussed are really excellent products. Mike, Himanshu, Matt, and Arnold are top-notch analysts and ambassadors of the tools, so I'm sure they'll do them justice. I'll even throw a couple in myself. So why don't we turn the conversation over to Camp? Mike, why don't you start with your insights on CAST and DDIS?
Thanks, Joel. And hi, everyone. My name is Mike Campolone, and I cover the retail sector for our Bloomberg Intelligence credit team. Today, I'm going to show you two functions that our team relies on primarily for issuer-level credit analysis. So the first, and you can go to the next slide, please. Yep, go back. There we go. So the first is CAST, which is Bloomberg's capital structure function. CAST provides an overview of a debtor's organizational and capital structure, including type of debt issued, ranked by seniority, the specific borrowing entity, and whether debt has recourse up the corporate tree. I'm using Macy's as an example here to highlight the entities that have current debt outstanding and where that debt sits on the corporate structure. CAST is a great landing page when performing issuer level analysis, and the function allows you to easily navigate to other Bloomberg tools like search, so you can see corresponding pricing and ratings information. You can also get a quick view of the guts of a specific security by hitting the eye icon that you see at the bottom on the far right, as well as historical pricing information. The columns I have displayed here on the bottom half of the screen within the Security Details tab, including price, spread, and yield, are all customizable to your preference. Okay, so now I'll move on to my next slide, please. So the second function that I wanted to show you is DDIS, which is Bloomberg's debt distribution tool. DDIS displays the maturity distribution of debt for a selected issuer, sector, fixed income index, or custom universe of securities from the SRCH function. So you can analyze the ability of an issuer or group of issuers to meet obligations to debt holders. You can analyze outstanding debt by type, payment rank, currency, and more, as well as compare the maturity distribution between two different entities. DDIS also lets you compare a single entity versus its debt distribution history to see how a company's maturity profile has changed quarter over quarter, year over year, etc. Beyond issuer level analysis, you can use DDIS to analyze the maturity profile of a sector or index, like the Bloomberg Barclays investment grade or high yield indices. Before I hand it over to my colleague, I just wanted to make an important point about the two tools I just showed you. CAST and DDIS are both functions that incorporate dynamic data sets instead of static data sets. So this means that data on CAST and DDIS is more current than quarterly reports. Numbers are updated to reflect issuance and redemptions throughout the accounting period. So it's not a matter of one data source, for example, FA, our fundamental analysis tool, CAST and DDIS being right and the other being wrong, but more so an opportunity for the two data sets to be used together when performing fundamental analysis. And now I'll turn it over to my colleague, Himanshu, who's going to walk you through our bond search tool, SRCH. Thanks everyone for the time today.
Thank you, Mike. Next slide, please. Good afternoon, everyone. My name is Himanshu, and I cover banks and financial companies for Bloomberg Intelligence. So my favorite function on the terminal is SRCH. It is short for Fixed Income Search. And it is basically what I call it as Google for Fixed Income Analyst. And the reason I say that is because it allows you to search Bloomberg's database of more than 40 million securities within seconds. But the best part is that it also allows you to tap Bloomberg's data fields to create a specialized list of securities so that you can generate investment ideas. So today I will go over two quick examples on how I use this function. The first one is on the slide here. So Canadian banks mostly issued preferred shares and some hybrids for their additional tier 1 capital. But last year, banks started issuing a new type of security called Limited Recourse Capital Notes, or LRCN for short. Now, there is a cap on how much the banks can issue these new securities. So you can run a search and quickly find these new securities on the terminal and see which bank has issued how much, and who might be the likely issuance candidates. You can then export your search to other Bloomberg functions like FIW, where you can compare bonds, track performance, monitor liquidity. And my second example is so second example will be regarding bail-in bonds. So different countries have different bail-in debt issuance requirement for their banks. And for those who don't cover or don't look at financials, bail-in debt is basically bonds that can be converted to equity or written down to save a failing bank. So in the US, banks can issue bail-in senior debt from the holding company and non-bail-in debt from the operating bank. In Canada, the banks can only issue bail-in senior debt. Whereas in most of Europe, banks issue tier 3 senior debt for bail-in. So you see how it gets confusing. So many different types of bail-in debt across so many different countries. But you can use SRCH to easily and quickly find all the bail-in and non-bail-in bonds globally. And again, you can export your results to functions like FIW to do relative value analysis. And finally, I just want to highlight one really cool feature in SRCH, and that is ask a question. And what this feature does, it allows you to search using natural language. So you can simply type all corporate bonds issued in past 5 years, or let's say pandemic bonds issued in 2020, or if you are a fan of Tesla, Tesla bonds issued this year. So that's all from me. I will pass it on to Matt.
You can go to the next slide. Okay, hi everyone, my name is Matt and I'm a credit analyst with Bloomberg Intelligence covering the industrial sector with Joel. And one of the functions I find myself gravitating toward most on the terminal is a function whose primary aim is for relative value analysis. And the function is called Fixed Income Worksheet, or FIW Go for terminal users. It's a pretty powerful function considering the breadth of analysis one can do and the function's ability to source from a variety of different FIW supported functions like port, IN, or SRCH, as He-Man just went over. Once you load your search or the index that you want to perform relative value for, you'll see the function is organized into 3 tabs that provide different types of comparative analysis, one being the matrix tab, the second being bond list, and the last, which you see here, is called bond chart. And you can switch between the tabs and the sub-tabs under the bond list section to display aggregate securities, the price for the bonds, and help identify rich and cheap values. You can also measure historical performance, as well as compare liquidity for the various bonds that you have in whatever selected list. The matrix tab is effectively an aggregate distribution for those bonds in whatever list you're looking at. You can find the count, average of bond metrics across the matrix for whatever bond attributes you care about most. The middle tab is called the bond list and is essentially allows you to do a complete assessment of an individual bond's health. So you can evaluate overall investment attractiveness for the bonds in your list, and those sub tabs that I referred to earlier offer a variety of ways to compare those bonds, from pricing source, movement, liquidity, rich, cheap for the bonds relative to sectors or benchmarks, maturities, or due amount outstanding comparisons. And so the variety of the analytical tools in the bond list adds up to a pretty comprehensive valuation for a bond's overall investment quality. And then the last tab, which you see here, is bond chart, and that's what's displayed here on this slide, comparing Boeing's bonds versus a large set of BBB tier industrial peers, so you can get a sense of how wide they currently trade versus the peer group. This tab allows you to analyze the relative richness or cheapness of bonds compared to these curves that you can build for custom comparison like yield, spread, maturity, duration, and even some fundamental data points that we have on the terminal like leverage or interest coverage. So you can slice and dice the data in a ton of different characteristics using the left and right hand rails by clicking on the chevrons to see the various stratifiers, which I've opened on both sides of the screen in front of you. Once you've drilled down to what you want, you can then select under the group by area for what the X and Y axes you want to use to look at your data. And as you can see here, I've selected spread and duration. And in the top right, I like that the function gives you the ability to use various pricing sources. So if you want to use something other than BVAL, which it defaults to, you can select something else like trace. You can just input TRMT or TRL1 to see bonds that have traded over 250,000 or 1 million bonds, and it'll update the chart in real time with the most recent data. And then below PCS on the right-hand rail, you can see the group by selection. So you can see a list of all the issuers that are in this particular search. And you'll notice there's a small chart box on the right with a curve in it, and that allows you to easily add a best fit regression curve to those bonds in the chart to get an idea how wide or tight the bonds trade relative to the issuer itself, the sector, or its credit ratings. And then I guess just quickly, you'll see there's a little sprocket in the right rail that gives you the ability to change the chart's background color to make your data point pop more, or switch your plot marker shape, enlarge or shrink both the X and Y font size as well as chart point size to really zero in or highlight the bonds that you find most or least attractive for whatever it is that you're analyzing. And so this is kind of the function that I found as one of the more useful ones for myself, and the one which typically garners a fair bit of interest on the part of clients of Bloomberg. I think I'm going to pass it off to my colleague Arnold Kukuda, who covers the banks with He-Man.
Great. Thanks, Matt. Can we turn to the next slide, please? Great, thank you. So we had great insights in some of the homegrown organic Bloomberg functions, but I'm going to talk about a key Bloomberg acquisition, and that may be a good segment actually to Joel's M&A analysis. So it's a new year. It's a great time to reflect, but let's roll back the clock 5 years to 2016. So most remember the year for Brexit and the election of Donald Trump. For me, in BI credit, the acquisition, the Barclays fixed income indices, that was pretty exciting for me at Bloomberg. So let's take a look at the index in action. So on the right-hand side of the chart, we see that post-financial crisis, the question was, when would financials, would financials start trading tighter than the old world index again, like pre-financial crisis? And that actually happened in 2013. And then this continued until 2020, until we hit the recession. And then now we're kind of back to the financials trading tighter. So what happened this time around in let's say March, April of last year? So, this time around, the Fed stepped in a lot more quickly. The various support initiatives that they put into place, some new ones as well. And then this time around, compared to 2008, 2009, the banks were much stronger and better capitalized. So, okay, on the left-hand side of the screen, that's the index homepage, IN Go. And I took a snapshot of the breakout under the corporate index. So as you can see, while the overall financial bond index, that trades tighter than the overall index, the average duration for financials of 6.5 years, that's also about 2 years shorter than the overall index. So let's keep that in mind. And can you turn to the next slide, please? On this one, we're going to talk about the Curve Finder CRVF Go. So this is where you can find the various credit curves by sector and issuers. And we're going to have Noel on later, who's going to talk about all the relative value between the sectors. But just wanted to show you on the bottom right, you can see that on a duration adjusted basis, the financials actually trade a little bit wider than the industrials. So more specifically, if you look at the curves, the A-rated financials in blue, that trades actually more like a BBB+ industrial in red. So on a duration adjusted basis, financials still trade a bit wider. So if we move on to the next slide, we're going to talk about portfolio analytics, PORT. So this is the great tool. If you're a former Barclays point user, I think this is a equivalent to that. But this is where you can slice and dice the Bloomberg Barclays index any way you want. This view that we have up here is the 2020 returns by both sector and then by ticker. So looking at the big US banks, which I cover, the winners of the 2020 excess return column, which looks at the issuer-specific returns above treasuries, and that, the winners there are Morgan Stanley and Goldman. So what happened last year is the traditional bank profits, they were hit by increased loan loss reserves, but the trading and investment banking, they were the standouts with the client portfolio repositioning from first the recession and then the recovery. And also on the investment banking side, debt and equity underwriting were very strong, as you all know. And then, so for Morgan Stanley specifically, they also benefited from shifting its model to more stable wealth management and asset management with the acquisitions of E-Trade and Eaton Vance, that over the more volatile trading. And they actually got upgraded by Moody's last year in a time when everybody else was getting downgraded. And still, and additionally, they're on positive watch again. And then delving further into Morgan Stanley, opening that view up, some of the Morgan Stanley's top returning bonds, if we look into it, they were the 10th and 30-year bonds that were issued in March and April of last year when there was all the worries going on, and and then right after we had the Fed step in on March 23rd to ease concern. So that wraps up my segment on port, and I will pass it on to Joel to talk about M&A.
All right, thanks, Arnold. Lauren, if we could go to the next slide, please. All right, thank you. All right, so I got the last pick in the function draft, so I cheated a little bit. I decided to go with actually two functions, MA and BUYP. Really, I kind of view these as complementary tools that can give clients a tremendous amount of information in a short period of time to help describe deal activity, or whether it's a company or a region or a sector. Above is just a small sample of what the MA function generates for clients, which describes in this picture multiples that a company has paid on average when it makes an acquisition. So in this case, you can see an EBITDA multiple of 15.5 times. One of the first questions that clients ping me on when an acquisition is announced is the deal pricey or is it cheap? Of course, more recently with low-cost funding for everybody, cheap has rarely been a response that I've been able to give. But with the MA function, I can quickly see what the multiples the company has paid, or expand more broadly what the average multiples have been paid for in the sector and in a region over whatever period of time that I'm engaged with. In this case, I've used the example of Danaher, which is an industrial that has evolved from an industrial tool maker and heavy-duty truck brake manufacturer into a diversified healthcare and environmental business. And as I said, it's paid about 15.5 times for acquisitions. I can also find in this function insights like 43% of the time the company's deals have been paid for in cash, with 73% of the deals being 500 million or less in size. All of that information, again, just comes from typing in MAGO into the terminal, and then the company's ticker, So in this case, DHR-US. By using BUYP as a complementary tool, I can better find out if I should get comfortable with Danaher making with what I would call niche acquisitions or tuck-in acquisitions of 500 million or less, or if those trends have actually been changing over time. So Lauren, if you can turn the slide, please. Thank you. All right, so I'm not sure if I mentioned, but Danaher is a serial acquirer. And as you can see on the left-hand side of the picture, it never stops chomping. The BUYP function tells me that the company has made 135 deals in its history. Note that the size of the green and orange bubbles, and the green and orange bubbles are each deal, and the size of the deal is also the size of the circle. And whether it's green or orange indicates what sector that they have been acquiring in. So you can see that historically, or at least through 2010, buying little small tuck-in transactions was really part of their strategy. But then in 2011, Danaher purchased Beckman Coulter for about $7 billion, and it recognized that it could manage larger deals from a management perspective. It also recognized that it didn't need its single A rating, and which it had held for years under Larry Culp, who's now the chairman of GE. So BUY clearly shows a strategy shift towards larger deals, And in this case, it's a cycle of lever to delever and then buy your next asset. Now that's something to consider for Danaher bondholders later this year, because the company's well positioned to take its next M&A bite. All this data comes from just typing in the company's ticker symbol. So again, DHRUS, and then adding in BUYP, and then the go key. As luck would have it, early on when the BI credit team was started, we built a debt capacity model, and that picture is on the right-hand side. And that's a perfect complement to MA and BUYP data. It happens to be an Excel sheet that any client can download and utilize for free. So we can take Danaher's historic multiples of 15.5 times EBITDA, its leverage goals, which are now 3 to 4 times, as well as 21 consensus, or whatever your own estimate is. And you can determine how much financial firepower it has to stay within the context of its BBB+ rating. Our Excel tool can be used for single name work, such as just doing it on Danaher, or as shown as on the right, a peer comparison, in this case for all the high-grade industrials. Next slide, please, Lauren. All right, so with that, why don't we jump into the next section, which is really starting our research. And we'll start with the macro views with rates and credit. Ira Jersey, who's our chief U.S. rate strategist, will start, followed by Noel on credit. Ira?
Thanks very much, Joel. Welcome to the webinar, everyone. So I'm going to talk very briefly about our view on U.S. rates, talk obviously a little bit about the Federal Reserve, although we think that they'll be reasonably boring this year. What might be more interesting is going to be the fiscal situation, particularly with some of the news that we've received in the last 24 hours. So if we can advance to the next slide, please. Maybe one more. Thank you. So one of the things that we do at the BI rates team is we put together several scorecards. Our two main scorecards that we put together using various data from the terminal, as well as some more subjective measures, is our duration and yield curve scorecard. So right now, our duration scorecard suggests that customers should be underweight duration. Basically, that duration is at risk of continuing to sell off, and that the market is a little bit overvalued compared to a variety of measures, including our own fair value model, although that is yellow here, saying that we're pretty close to fair value. But things like economic momentum improving, as well as market technicals, because there's going to be additional issuance in the Treasury market during a period of better economic momentum, suggests that that the market is going to be a little bit weak. On the other side, one of the big positives is the fact that that precious metals are outperforming some industrial metals, and that's at the time when we had redone our scorecard about a week ago, that was the case. That's actually subsequently turned around over the last couple of days. But the point is that this is our systemic way of making sure that we regularly view the market. We do put this out in our monthly every month, and if you go to the data tab within the piece, the note that we write about this, you can actually pull up an Excel file, and when you click on all of the gray buttons that are on this spreadsheet, you can get terminal functions that show the variety of data that we utilize within here, and I'll show you one or two of those in just a second. The bottom portion of our scorecard shows our yield curve scorecard, and the yield curve scorecard is suggesting that the curve should bear steepen. The longer end continues to be at risk. When you look at things like leading indicators, a function called GOVY, which I won't be showing you here, but it's a relative value tool that we use for evaluating different parts of the Treasury curve, that also is suggesting that the 30-year is significantly overvalued, while the 10-year is actually very undervalued, and that the 10-year has actually underperformed along the curve quite significantly over the last couple of weeks. And then monetary policy favors the short end, because the Fed is going to likely be on hold for a long period of time, and that means that they'll drive inflation higher. You even heard that today, for example, where you had Richard Clarida saying that it was going to be at least a year with 2% inflation before he would think that they were going to hike interest rates. So that should mean that the long end of the curve should steepen quite significantly. So if we move on. Yeah, there we go. So economic momentum is picking up, or at least remaining somewhat stable. When you look at things like ISM new orders, we're well above 50, so well above what suggests for that growth is going to continue. Momentum continues upward, and this tends to be good for the economy, bad for interest rates in general, because the reason why interest rates are as low as they were was because of the significant downturn in economic activity and economic momentum. Moving on. So we also model a variety of rates, and I'm going to show you a few of the outputs of our model now. So these are fundamental models that utilize inputs that include GDP, CPI, and then we put in consensus forecasts. So when we take the Bloomberg consensus and say, okay, the median forecast shows X for GDP, Y for CPI, and then a couple of other indicators. One that we actually estimate ourselves, which is the amount of the Treasury market held by the Federal Reserve. We can get an idea about where fair value currently is, which right now 10-year Treasury yields are right at fair value. They're actually slightly cheap now, but not very much. And then how they might progress over some time horizon. And so at the end of this year, the model is suggesting that that 10-year Treasury yield should only be around 1.1%. We think that the model is not taking into account additional fiscal stimulus that's likely to be generated into the over the next couple of months from Congress and President-elect Biden. So we do think that yields will be somewhat higher. Our current yield scenario, our base case scenario for yields is currently that they'll rise to 1.5% this year, 1.75% next year. That's partially because we do think that the Federal Reserve will continue to be easy, and then it'll be harder and harder for the market to sell off as monetary policy remains easy. That being said, we are reevaluating that based on the fact that it does look like we're going to have a bit more fiscal stimulus than we originally thought. So when we came out with these scenarios earlier in the year, it looked like at the time that the Senate would remain Republican and that we'd get a more modest fiscal stimulus somewhere in the $600 to $800 billion range. But with talk of a $2 trillion fiscal stimulus, then obviously that will have both supply effects, given that you'll have a lot more treasuries, but it may also have some effect on the economy going forward, and that will obviously have potentially a more bearish tone on the market than we were originally thinking when we had put out these scenarios. Moving on to the next slide is going to be the 30-year model. So again, this is very similar. What's interesting about the 30-year model is that when you look at when the model gets to be about one standard deviation below the that's a really good time to sell the market. It's worked almost every single time, and just the opposite when yields get a standard deviation above the fair value model, then you want to be a buyer. We're still very, very rich to the model at the moment. So we do think, and this is one of the inputs when you look at our scorecard for the yield curve, and this suggests that maybe the yield curve should continue to bear steepen. That being said, and we found this very interesting when we looked at all of this at the beginning of last week. If you go to the next page, you'll see our next model is going to be our yield curve model. And when you look at our 10-year versus 30-year yield curve model, what we saw last week was that it was right at fair value. So the implication of this is that the 10-year had been selling off and quite significantly along the yield curve and has gotten somewhat cheap according to a variety of different models. But the 10s/30 curve doesn't necessarily have to move very much. So it's very possible that, at least for the near term, that you could see a symmetrical move higher in yields for the 10/30 curve. Now, I do think that because of the Federal Reserve, that the 2-year, 3-year part of the curve is going to remain very static over the course of 2021. And that suggests that when we talk about yield curves bear steepening, that it is more of the 2s, 10s curve that's going to move, or the 5s, 30s curve that's going to move, as opposed to 10s, 30s, which it looks like it might remain a little bit more stable at the moment. And moving on. When we look at the Federal Reserve and what the market's pricing for it, the market is not pricing for the Fed to do very much over the next 2 years. When you look at Fed funds futures, when you look at overnight index swaps, all of these indicators are suggesting that the Federal Reserve is not going to hike until late 2023. So right now and this is one of the reasons why we think that the front end is going to remain very stable. Now, that doesn't mean that the Fed won't take some kind of hawkish action. For example, there's been a lot of talk and a lot of questions about whether or not they're going to cut their asset purchases. We think that they won't cut their asset purchases until sometime in 2022. There is the outside chance that later this year, maybe fourth quarter, that the Federal Reserve could cut, but that's a very outlier scenario where the economy would have to recover so robustly in the second and third quarters that they felt like they had the opportunity to cut. But with another $2 trillion of fiscal stimulus, I very much doubt that they're going to be happy to reduce their asset purchases until the fiscal situation stabilizes a little bit, as well as they see that uptick in inflation that I mentioned about Richard Clarida and others at the Federal Reserve Board talking about. Moving on. One of the concerns, and obviously this is one of the reasons why excess supply is going to get a lot of attention, particularly if we get another $2 trillion fiscal stimulus, and that's that debt to GDP in the US is going to rise to well above 100%. The last time it was at those kinds of levels was during the Second World War, and there's going to be a lot of people wondering if this is sustainable. My take on it is it's not a matter of debt sustainability. So you can't look at the United States government the same way that you look at a credit. But what you can say is that it does reduce potential fiscal flexibility going forward, because the ability of the federal government to roll over its debt is probably going to continue to be exceptionally high. But the problem is as the debt grows larger and larger, and should interest rates go up, the refinancing obviously of issues coming due is going to continue to increase the debt service of the government, and that means that a larger and larger portion of federal spending is going to go to interest as opposed to be going to the public welfare of the taxpayers who are paying into who are ultimately going to be responsible for this debt. So I think that's the big issue. So the question is, if we get another $2 trillion fiscal stimulus, is that the last one that we might see of the cycle? One would hope as a taxpayer that was the case, but there's certainly no guarantee of that. But as the economy recovers, the idea would be that the economy should recover fast enough that debt to GDP can fall back down to what I would call more normal levels, which isn't necessarily 40%, but more like 50 or 60% debt to GDP. But that will take several years to occur at this point, even if you had nominal GDP growing at say 6 or 7%, which would be 4% real GDP and 3% inflation, which is not a tenable situation for the Fed. So they would probably want to slow that type of growth down if it were to occur. So the chances of that are probably pretty low. So in reality, you're probably looking at nominal GDP growth closer to 4%, which means that it would take somewhere around a decade to get back to that kind of level. And that's assuming that that the deficit were to shrink to just a couple of percent of GDP. So if we go to next. I'm going to speed things up here just a tad. Just suffice it to say that deficits have very little bearing on what happens to Treasury yields. In fact, you've had increasing deficits for long periods of time, and meanwhile you've had Treasury yields that continue to fall. The two situations where we did have rising growth and rising deficits in the past did lead to much higher Treasury yields on a cyclical basis. So remember, we're talking about cycle, not trend here. So where will we go if we go back to the very long-term trend in 10-year yields? You're talking about 10-year yields at 3%. So does that mean that the 40-year downtrend in Treasury yields is going to be broken? Not until we break above 3%. If that were to happen, then we can have a different conversation. But at least for now, think about the yield highs over the next couple of years with 10-year yield maybe back up toward 3%. But I think that's likely more to be a 2022, 2023 type situation than it is a 2021 realistic scenario. Moving on. I'm going to actually skip this one. So if we go one more, just in the interest of time, suffice it to say that when T-bills are issued, the T-bills get cheap to other front-end product. Foreigners have been the incremental buyer of the Treasury market, and that's very obvious. In particular, when you see the Treasury international capital data come out, look at the private flows from foreign investors. Don't look at the overall numbers. You'll see red headlines that, on the terminal that say, you know, China did this, Japan did that, blah, blah, blah. It doesn't matter. They don't, the official holders like SAFE or the Ministry of Finance in Japan, with the state agency for foreign exchange in China, they tend to buy very short-term debt. So they will buy, you know, 1 year, 2 year, 3 year Treasury securities, or they'll let them roll off, and that's when their holdings go down. What's more important is the private purchasers of Treasury securities, and I would argue corporates as well, and that's because they take more market-type risk. So because they do, they tend to be they tend to have an influence on where Treasury yields go. And when you see foreign holdings going up or down, again, deviating from a very long-term trend that we've observed, you can see that Treasury yields tend to follow suit. The problem with foreign Treasury holdings is that the data is very old. It's 6 weeks old, which I know for you guys who only get quarterly data, that seems very fast. But for you know, a Treasury guy like me, that's kind of ancient history. But nonetheless, when we talk to foreign investors and we say, okay, well, you know, why do you have to buy U.S. Treasuries? It is because the U.S. is still a relatively high yielder compared to others, compared to other yields, like with negative yields in Germany, for example, and very low yields in Japan as well. They have to buy US dollars. They also have dollar liabilities. So you're talking about insurance companies, for example, that might have some of their liabilities in US dollars, so they want to match that with a dollar product. And moving on. So where do we see treasuries at the end of the year? We're a little bit more bearish than both the consensus and what the market is currently implying. We do think that 30-year yields can rise pretty significantly in the second half of the year, particularly if we get that $2 trillion fiscal stimulus. Could wind up seeing 2.5% 30-year yields. That's, you know, much more significant than what the market's pricing at around. It's actually a little bit higher now, about 1.9%. And then we see that we still see higher yields in 2022, but at a little bit of a slower pace. But we could touch at some point during the year a 3% 30-year and a 2%, or maybe even a little above 2% 10-year yield. And all of this in a generally speaking a curve steepening environment, at least in things like 5s, 10s, 2s, 10s, etc. Moving on. And I just need to mention one more thing for this year. I'm going to not go through these two slides, but suffice it to say that we have a lot of information on the Bloomberg terminal about this, both from news and strategy. But that's that there is a transition going on that many of you should care about, which is that LIBOR is going to transition to another reference rate called the Secured Overnight Financing Rate, or SOFR. There's been a significant amount of chatter about this, but with the likelihood that you have a lot of regulators that are going to be telling financial institutions that they cannot do any more new LIBOR related either derivatives or cash product by the end of 2021, you're going to see this transition just exponentially get faster, and a lot more questions, a lot more headlines about this transition. We have a LIBOR primer. You can find it at BI space rates. We're in the process of updating it right now. That is a collaboration. Joel mentioned the collaboration between different teams. So we have folks from litigation, people from our political policy team, as well as some of our colleagues in Europe that are helping us to analyze and try to give good information and color as to how the transition will develop. And one of the things that we've noticed over the course of the past year, we use that SRCH function to create this particular chart that you're looking at, is that SOFR related issuance from US domiciled issuers has increased and actually surpassed LIBOR-based product over the past 6 or 7 months. It's primarily from the GSEs, but banks now are picking up their issuance of SOFR-related debt as well. And as this cash issuance picks up, derivative volume should follow and continue to increase significantly as well as these products are hedged. And with that, I think I'm going to pass things over to my boss, Noel Hebert.
Thanks, Ira. Appreciate that. So, listen, before I dig into my part, I think one of the things that's important to mention, just because of the presentations that we heard heretofore, certainly as Ira had to accelerate through the end of his presentation, one of the great things about Bloomberg Intelligence, whether it's the credit team or the strategy team or any of our other teams, is that we're all freely available to any of our clients. So if you thought some of those slides that Ira had to buzz through were pretty interesting and you want to know more about them, you can always just reach out to Ira. So with that, if we can move to the next slide and maybe just one more slide. There we go. And so, listen, I mean, I think Ira hit on a lot of the big things that are going to really matter, certainly for investment grade corporates, given we entered the year with record high duration and record low yield at 1.74%. So a lot of the total return profile that we're looking for in the year ahead is really going to be a function of what happens with the treasury market. So if we get anything like, and here what we're looking at is a simplified total return model given a scenario analysis of outcomes for spreads, which you see on the left-hand margin, or changes in the 10-year treasury, which is in that upper banner. So the summary here being, if we realize IRA's 1.5% treasury 10-year at the end of the year, you're losing money in investment grade. It's just a function of how much, right? In order to minimize the pain, you're going to have to be pretty much setting record lows in spreads to have any hope of even breaking even. You're really going to need a treasury 10-year that's going to be closer to or inside of 1.1%, I think, in order to get to a place where you're delivering positive total returns. If we move to the next slide. So the other component of this obviously is going to be if we, when we're talking about yields, is going to be spread. So if treasuries are going to finish up somewhere, whether it's 150 or 1.25 or wherever, we're going to need spread to do a fair amount of work to help sort of minimize the pain. High level summary here is that over the intermediate term, we could get some of that. So if we look at the graphic here on the left-hand side, basically you're looking at a long-term downward trend channel for investment grade OAS, where the bottom end of that, which right now would sit right about 80 basis points. That's certainly a level relative to 96 basis points, which is where we entered the year. That's certainly a level we can test down to, I think, over the first half of the year, but it's not necessarily where I see us finishing. Over the course of the year, if you look at our fair value model, which is to the right here and similar to IRA, a lot of the inputs here are, shape of treasury curve, various economic inputs, as well as corporate fundamentals. What we're pointing to here is, basically 140 basis points. I don't think we're going there either. And the reason is because of what Ira said earlier, which is the Fed is going to stay active with QE throughout the course of the year. And as the Fed, if you look at periods of active Fed versus idle Fed, it's generally worth about 35 to 40 basis points. So if we strip that 40 basis points back from the model, what that gets us to is somewhere around year end about 100 to 105 basis points in spread, which would be a little bit up from where we ended the year, which long story short, you basically end up in an environment where both treasuries are going to hurt you and maybe spreads also hurt you a little bit. So that sort of raises the question, how do you insulate? How do you play defense in an environment where, because you're entering with this steep duration profile, you need to find a way to make money or at least not lose so much money. So if we move to the next slide, one of the ways that I like thinking about this, or at least an initial way, and Arnold spoke to it a little bit when he talked about financials and duration adjusted spread earlier on. One of the first things I like to do is break down spread and yield against duration to get a sense of how much wiggle room do you have before you start breaking even. So in very simplified terms, and obviously the numbers aren't going to be exact because the math changes as the spreads and yields change, but the summary is right now in something like basic materials or energy, you're going to get 13 basis points or 16 basis points of spread widening before you're offsetting excess returns. In financials, you're about 13 basis points. So those would be your three highest sectors. With basics and energy, it's more a function of excess spread sort of entering the year as opposed to duration. And if you think it's sort of a more favorable macroeconomic backdrop, like I was sort of alluding to feeding into his treasury model, if you get that, those are sectors that should probably outperform, and we should see that gap narrow. Financials, alternatively, at 13 basis points, you're about a couple basis points wide of industrials overall. And that's basically in line with historicals, and obviously that's all a function of duration because you have some of the lowest spread anywhere but because the duration is so much shorter, obviously you get a little bit of extra compensation there. But you always, with the exception, well, let me rephrase. Since the financial crisis, financials have always traded a little bit wide, generally 2 to 5 basis points wide, except for widening cycles when people run out of duration and into the shorter duration instruments. So if you're in a steepener, this is where you can see financials start to collapse that differential with other sectors, maybe not delivering positive returns, but delivering less negative returns. Alternatively, depending on how the world works out, if you get to a world where you get pre-great financial crisis and everybody feels super hunky-dory about the world at large, financials historically used to actually always trade tight to everything. I don't know that we're going there, but if we do get a steepener, they should outperform. If we move to the next slide. Another place to think about sort of insulation in an environment where we're steepening, particularly to the degree that Ira mentioned, is to think about the shape of credit curves and spread curves. So here we're looking at sectors. I apologize for a little bit of the spaghetti chart here, but what you're seeing here is you got, in every sector, you got parts of the curve that maybe give you a little bit steeper slope, i.e. a little bit greater roll down. And that roll down in spread, as you move from, say, a 7-year to a 5-year or a 5-year to a 3-year, helps provide you a little bit of an insulation as the Treasury curve steepens and maybe helps offset some of that move in terms of delivering total return. So for something like, consumer cyclicals, you're looking more in the 10 to 7-year. Something like communications, you're looking at the 7 to 5-year. If you're looking at energy, it's basically the entire curve because it's the only curve that really offers steepness throughout. And obviously there's been a lot of obvious reasons for that, stemming back to last year when obviously oil prices traded negative for a very short period of time. That sector still hasn't sort of caught up to the rest of the investment grade universe. So if you're looking for insulation and you feel comfortable in triple B energy, that would be the place where you're going to get the greatest roll down. Next slide. Another strategy, but probably a less successful strategy overall, would be to look for outliers in a given universe. And this is really only going to be successful if you're looking at just maximizing your current carry in the environment because of two factors. One, the outlier pools are pretty small. So finding anything that's sort of in excess of, call it 200 or 225 basis points in triple Bs is a challenge these days. Within single A's, finding anything above 130 basis points is pretty much a challenge. So you're going to be taking something that's got a little bit of a credit profile issue. That's why we've got a great single name credit team. Alternatively, you're also going to be taking on a fair amount of duration. So if you look at where a lot of these higher spread instruments sit, a lot of them are sitting 15 to 20 years. So even though we've got the 20-year treasury, you're still kind of off the run there. And so your liquidity profile of those bonds is a little bit diminished. So, not without here, but again, if you're looking to just add total carry, there are pockets in each of the sectors where you can go and find it. There's not going to be a lot of them. If we move to the next slide. Oh, one back. There we go. So one last place to maybe play a little bit of defense within the investment grade landscape is floaters, right? I mean, if you're in a curve steepening environment in particular, right, floating rate notes basically have no duration or de minimis duration. So you're not going to get the pain associated with that. And on the flip side, if we look at just pure valuation terms in terms of where floaters are today versus historical, you're not really cheap, but you're still modestly discounted towards industrials in terms of spread. Relative to where we've been historically. So maybe a little bit of room for added compression and again, sort of insulation against duration profile. Not huge returns. You're talking about, low single digits, very low single digits perhaps, but low single digits is better than low negative single digits. So wrapping up on investment grade with the next slide. Here we go. So just quickly in the environment, one place where we might find a little bit of support is sort of the fall off in new issuance that we're expecting this year, which should sustain spreads a little bit and keep them from running away from us. We look for investment grade issuers to come through with basically half of last year's total issuance. So last year we got, when you roll it all up and you clean the numbers up, you get about $1.8 trillion in terms of new issuance paper last year. We look for something more like 900 billion to $1 trillion this year. And the reasons for that are a couple fold. First and foremost, the maturity schedule is pretty light relative to prior years. We entered with less than 900 billion coming into the year. And the second very important point is a lot of that 1.8 trillion last year, about 1 trillion of which was net issuance, a lot of that's still sitting on corporate balance sheets. So we estimate that upwards of $600 billion of that is still idle in corporate balance sheets today, at least among the investment grade index constituents. So that's a lot of money that can obviously feed some of the maturities due this year, but also other initiatives, whether it's shareholder returns, M&A, et cetera, all contributing to basically a weaker total new issuance calendar in the year ahead. If we turn quickly to high yield, running through the same exercise, starting with the next slide. Won't belabor this. Summary here is, right now, I think most of the year in high yield and spread terms gets spent between basically 352 and 400 basis points. Good consolidation there, certainly throughout the course of 2019. Still not supported by fundamentals, which still look a lot uglier than those levels. That said, this is where we are today. I think to the downside, we've certainly got momentum that's carrying us right now. That could carry us certainly to 330. If we break that, which I'm not totally confident we do, you could test down towards 300. But again, I think most of the year gets spent in sort of that 350 to 400 basis point range, which entering the year, we came in at 360. So we're looking for, again, sort of a little bit of change, maybe a little bit wider, not that dissimilar to what we're looking for in investment grade. Just in the natural course of the year, you could trade up towards 425, 450. If we get a little bit of a risk off, you can go wider still. Contrasting with the model is looking for something north of 500 basis points. And again, part of the function there is we got such horrible fundamentals right now because we're looking at obviously earnings and everything else through 3Q of last year. So we're basically looking at still near record leverage for the asset class. While we expect new orders to stay in positive territory, we expect them to decelerate from record highs. And then we also look for volatility to ebb. All that contributes to about 550 or so basis points. But again, similar to the IG model, within high yield, the Fed dynamic is worth about 100 basis points. If we strip that out, that would get us to about 450. Again, I think we probably finish below that, certainly if we get the macro backdrop that I was speaking to. If we move to the next slide. So here, similar to what we saw in investment grade, so this is a high yield scenario analysis in terms of total return expectations. The upside here is you're probably in positive territory by the end of the year in terms of total return for high yield, with the risk being that you're really not going to deliver your coupon. Coupon entering the year was pretty anemic itself at not quite 4.2%. And there's only a handful of scenarios in which you're going to deliver that. One is if your 7-year treasury is steady or lower, which, again, is already not the case and sounds like it's going to be even less the case as we move throughout the year. And then two, if we move, steeply lower, about 100 basis points lower in OAS. So you need about 260 basis points in OAS in a steady 7-year. I don't think you're going to get either of those. So that really moves our viewpoint here further to the right, and sort of those two rightmost columns. In summary being that you're going to get somewhere, we're looking for maybe 1 to 3%, 1 to 4% being the most likely higher probability range of outcomes. And the reason is, one, given the starting yield, right, you still got to anticipate the rate of defaults. Now I know Fitch just came out and reduced their sort of year ahead forecast for the default rates to, I think, 3.5%. So that would make them the low man on the street. I've seen anything from 3s to 6 to 9. I'm sort of in the middle of that range of sort of 5 to 6% in terms of default rates for the year. But even if we get something like that 3.5%, that's going to weigh on total returns by, basically 2 2/3% over the course of the year. So that'll hit total returns. And again, sort of 1 to 3%, 0 to 4% probably seems like the most probable range. If we move to the next slide. In terms of, where I like high yield or what I think is at least a little bit better looking than some of the rest, a large part of the rally that we saw certainly over the course of 4Q and into the early part of this year has been driven by triple Cs, which are sitting near cycle tights relative to every other asset class pretty much. So not a lot of value left in that pocket. But double Bs, partly because of the incursion of all the fallen angels over the last 12 months or so, continues to look pretty good, both relative to triple Bs and relative to single Bs. So in the upper part of the graphic, what we're looking at is spread ratios between the different ratings buckets. So the orange line would be double Bs versus single Bs. And there you can see not quite 70%. So double B spread is 70% that of single Bs. Basically in line with long-term norms there at the midpoint, a little bit cheap. Whereas versus triple Bs, so that crossover opportunity for those core plus type investors that have the opportunity to dip down below the investment grade line, you're trading 2.2 times in spread terms. And when you start to duration adjust that spread, which is what we're looking at in the pink line at the lower part here, you're at a record 4.3 times in terms of double B spread relative to triple B spread. So again, the up in credit quality dynamic within high yield, which I think could be favorable, as well as maybe a little bit of crossover from investment grade, just given how tight triple Bs have gotten. Both of those maybe feed into double Bs maybe narrowing the gap or the discount that they are experiencing right now. So if we move to the next slide. So one of the things I think, and this is truest for single Bs, but it's true across all of high yield, to be mindful of, particularly in this environment, and particularly to the extent that spreads are not able to offset a curve steepener in treasuries, is that you're dealing with a very negatively convex instrument here. And again, that's more true for single Bs than anywhere else, but it's true across the spectrum. So what that means is basically you can expect weaker levels of positive returns when spreads compress or yields compress, then you can expect losses when yields rise. So here we're looking at by sector, what you can expect in terms of price change in an average bond when yields change by increments of 100 basis points. So, price performance is relatively matched in that first 100 basis points. You can win 3.1% or you can lose 3.2%. It's that next increment where that negative convexity really starts to kick in more materially. So you can see as you go from up 100 basis points in terms of yields to up 200 basis points, that incremental loss is 3.6, compounding that 3.2. Whereas that incremental 100 basis points of compression is basically only going to make you 3%, right? And so the reason that is obviously we're dealing with an asset class where you've got a lot of call features. So you have a natural tether in terms of how high prices can go, just because you start shortening the effective maturity date if spreads get too low. So long story short, your downside risk or your price action is a little bit more exposed, all outside of energy, that is, because it's the only asset class that trades below par on average, or the only sector. So, just something to, again, be mindful of. If we move to the next slide. Again, so let me just wrap my portion sort of again with the new issuance side, and then I'll turn it over. But again, not that dissimilar to investment grade, though a much smaller magnitude, looking for sharply lower new issuance this year. Last year, we got about 450 billion, a little bit above for the asset class. This year, we're entering both with a pretty quiet maturity schedule, and you've got the same mechanic that we had in investment grade in terms of a lot of the issuance of the prior year is still sitting as idle cash on balance sheets. And you also have a dynamic of a rising rate environment, which historically tends to feed a little bit more of activity into the loan market and away from corporates. You roll all those things together, and I'm looking for something on the order of 275 billion plus or minus for new issuance for the year. So with that, let me go ahead and finalize by saying all this, of course, is available on Terminal. If you have any questions on any of it, you can certainly reach out to any of us here. With that, let me turn it over to the credit team, and I believe, Jody, you're leading off.
Hi, everyone. How are you? So I'm Jody Lurie. I cover travel, leisure, lodging, and gaming, and I'll be here talking about one of the most fun subsectors within travel, leisure, lodging, and gaming, which is the cruise lines. Next slide, please. So to set the stage about the cruise lines, when you think about the industry as a whole, there's been no other segment of the industry that has completely shut down the way that the cruise lines have. When you think about it, all these other industries have been able to pivot and salvage some of their business. Even the movie theaters, mind you, are going through some restructurings, but they even have an offering to offset the environment where you can rent out a theater, you can get takeout at a restaurant, you can do all sorts of things. Hotels, you can still use a hotel, but you can't use cruise lines. Now, the story has changed over the last 10 months. And the reason for the story changing over the last 10 months is a few things. Number one, the access to the capital markets. Even though the cruise lines themselves weren't part of the Fed bond buying because of where their employees are based and because of where they're domiciled, at the same time, they did benefit from a secondary basis. So that's number one. They've been able to fully access the capital markets. Number two, they benefited tremendously from the vaccine. And what we're seeing here is the default rates for Carnival and Royal Caribbean. Now, Carnival is the red and Royal Caribbean is the blue. And you're seeing that for both Carnival and Royal Caribbean across the horizon, so across the 1 year to the 10-year default rates, you're seeing a dramatic change from October to January. If you were to look back to April, I'm sure you'd see an even more dramatic change because of their ability to increase the amount of cash that they had on hand. But that being said, just looking at that, you see a tremendous change. Even so, you still see that there's a 10% default rate for Royal Caribbean going out 1 year. And going out 10 years, you're talking 70%. So it's not quite out of the woods yet. And I'm here to tell you that, in my opinion, I don't know if the upside potential is really worth the downside risk. The reason being is that in 2021, we're in a better spot than we were, say, 5 months ago. But 2022, it gets a little bit hazy. And with the pace that everything is going in terms of the return to normal, it's going to take a little bit to get there. And the cruise lines just don't have the cushion in order to do it. So next slide, please. So if you see on this slide, we have a chart showing how their capital structures have become more complex. Going into the pandemic and the few years leading up to it, they had a much more benign capital structure. It was very vanilla with senior unsecureds and some revolver, and now all of a sudden they have all different kinds of tranches. And most of the, mostly they've communicated that they're full on their senior secureds. Some of them still have a little bit of room on the senior unsecureds, but really at the end of the day, if they wanted to issue additional capital, they need to go into the equity markets, or converts they can also do. And we've seen that a little bit. But going into the end of the year, the companies did tap the capital markets. It was a good response, which was a big positive for them. And as a result, they're sitting on about 20 billion or so in cash on hand, 22 billion in cash on hand. But if you factor in what their cash burn has been, if you go from fourth quarter of 2020 until fourth quarter of 2021, you're looking at about a 17% cash burn rate. And that's a cash burn rate not factoring in any sort of additional costs related to getting back into the water, which could be a little bit more expensive. The CDC, after all, has imposed a few restrictions on them in terms of how to get back into the water. And so when you think about all the additional sort of unknown costs, that adds an extra pressure. The companies have been starting to tick up their marketing efforts in order to get additional cash in the door in other measures. Their advanced bookings is traditionally a good way for them to get additional cash in the door. And you're seeing Norwegian market out to 2023 as a way to sort of get their loyal customer base, which they do have a pretty loyal customer base, to start thinking ahead and thinking about them getting back in the water. And that could be their saving grace. If their customer base comes through and they're able to keep the amount of advanced bookings in terms of credits as opposed to giving cash refunds, that would certainly help them. But at the end of the day, when you think about it, they have, so we said they have 22 billion cash on hand. They have 17 billion in cash flows for the 5 quarters of fourth quarter 2020 until fourth quarter 2021. And then you tack on that another 4 billion in debt that matures in 2021. Now, thinking about 2022, they have about 8 billion in cash, in debt, maturing. And so that's where we see the risk, is in 2022. And an argument that constantly is floated out to me is, well, they do have this tremendous amount of assets on hand. And yes, they do have a tremendous amount of assets. They have all these ships. And Carnival is capitalizing on that, and they're selling 19 of their ships. And they're in the process of selling it. They've had some good traction. But at the end of the day, between the fact that a lot of their assets are tied up in secured debt and the fact that you can't really sell 100, 200 ships all at once, it's not really the most feasible of arguments to be able to say that they could just sell their assets in order to raise any cash that they need. Next slide, please. So what are we looking at? So I looked at going back to March of last year, back when high yield, when the Bloomberg Barclays high yield index was at its lowest. And I looked at what returns were from that point until the end of December. And what you're seeing is, if you compare it with the different senior unsecureds that were outstanding prior to the pandemic, so these are all senior unsecureds that were issued prior to the pandemic, you're seeing that Royal Caribbean and Norwegian outperformed. There are some caveats to it. Number one, Royal Caribbean and Norwegian have made cold calls as well as calls before their maturities. Particularly Norwegian's bond has a call feature starting this year. So in theory, they could take that bond out. I don't think they will given the coupon, but that is possible. Carnival's is a traditional bullet, and you're seeing how that underperformed the market. And part of that is a function of the fact that their capital structure has just become much more complex. And it's a company that historically was investment grade, likes being investment grade, and all of a sudden they're dealing as a single B company. Next slide, please. But at the end of the day, the equity markets are seeing value in their assets. They're seeing value in this turnaround story, and they're pricing it as such. And you're seeing how much farther out, and if you look at the right side of the slide, how much farther out their market cap is over their peers in that single B space. If you look at all three cruise lines, the story is the same, although a little bit different. And then you match that against 1-year default rates, and it also is an outlier. So you say, wait a minute, nothing really matches up. So you're saying that the equity markets are showing this tremendous amount of confidence in the companies, but at the same time, default risk is still elevated. And then if you look at the slide on, if you look at the chart on the left, you notice that they're also outliers. And the reason why they're outliers is because you expect that their leverage ratios are going to be much higher than their peers in 2022, but also you see that you're getting paid for that additional risk. I would say now to bring back some of Noel's points, that I don't know if you're necessarily getting compensated for that risk, particularly when you think about single B versus double B, as Noel mentioned. I don't know if you're necessarily getting compensated for the additional risk you're taking on for these companies, given where they are and given the fact that they're still not operational. Of course, if you look at this chart, you're comparing these companies to triple B as well as double B and single B and triple C rated companies, but they're all companies within the leisure, lodging, and gaming industry. And most of the other companies in the industry are actually operational, at least at some level. Next slide, please. Now here you're seeing the FIW chart in action. And the FIW chart, we mapped the cruise lines against similar leisure companies in the single B, double B, and triple C area. And you'll see that the curve is relatively tight. And it's not completely on top of the all leisure curve, but there's very little room of upside in terms of how you can get the cruise curve on. In fact, some of the cruise bonds are on the all leisure curve. So I would say that a lot of the upside potential is priced in, at least compared to a lot of their peers. And the only outliers above the cruise curve are really companies that are a little bit shakier ground, companies that were LBO'd resort bonds, or some of the movie theater bonds, which we know the story there is a little bit different. But by and large, again, I would say that really the value proposition of getting into the cruise lines now is not as much there as one would expect. Next slide, please. And at this point of time, while you could make an argument about one company being better than another company and one company better positioned than another company, the bonds are trading relatively in line with each other. You're seeing that their yields are, for the most part, within a band of each other. There is exceptions with Viking, which is a little bit less transparent in terms of their operations. It's also a smaller company and it's also lower rated. But that said, you're seeing that the companies are within a band of each other. And I think that that really speaks to the industry as a whole. The industry as a whole is sort of moving lockstep because they're not operating. They're figuring out ways to get back in the water. They're figuring out ways to not have negative headline risk, like we saw with Royal Caribbean with their cruise to nowhere in Singapore that resulted in a false positive and they had to turn the ship around. Carnival has been operational off and on within the Mediterranean, but you're dealing with a lot of geopolitical risks. You're dealing with the potential for a new COVID variant. You're dealing with the rollout of the vaccine, which may or may not happen quickly. And so the cruise lines, while they may become operational again, I think the biggest problem is that they have minimal cushion. They have minimal opportunities of things that they can do in order to get themselves beyond that hump. And I think it's a case of whether or not they're able to withstand the environment for much longer, and whether the capital markets will continue to be open for them in order for them to get to that point where they can be operational and be returning to normal. So with that, I'm going to turn it over to my colleague, Jamin.
Thanks, Laurie. I'm told that we're running a little bit short of time here, so I'm going to try to slice through my my slides at warp speed. I was going to talk about two companies. The first of which, next slide, please. Both are high yield. One's in the utility sector. The other one's in the integrated oil sector, LATAM. First of all, here looking at First Energy, you can see that from this slide that First Energy trades 90 basis points wide of other utility holding companies. That's a big spread. The company's ratings were recently downgraded to high yield following a federal investigation into bribery charges. But you know, very quickly to summarize, it seems to us that the associated decline in First Energy's equity of about 7.2 billion and an accompanying drop of around almost 500 million in the market value of its debt may be somewhat overdone. Next slide, please. Why do we like First Energy? What makes it special from our perspective? While we view most favorably about the company is its cash flow diversity across 13 regulated utilities in 6 states. This gives it an edge from a credit standpoint over other utility companies. So while there may not be an obvious path for First Energy's credit ratings back to investment grade in the near term, the high yield on its notes could compensate for the risks associated with the investigation. Next slide, please. Next slide. Thanks. Just very quickly looking at the bond spread, you've obviously got a wide variety, big spectrum of maturities, but it's at 3.9 and 4.85 maturities, 27s and the 2047s, with relatively higher coupons, which we think might be the most interesting to look at. Quick comparison to the IPPs. Next slide, please. And what I'm trying to point out here is that you've got First Energy at sort of that double B compared to the Vistra and NRG bonds, the independent power producers, also at that rating. Those are unsecured bonds as well, of course. So it shows you, you know, if these things had to widen out a little bit more, the amount of spread that's left for widening is somewhat less. And as you saw on the other slide, the tightening room is around 90 basis points, so significantly more room to tighten than there is for widening, at least from our perspective. Okay, so next slide. Thanks. Sorry, I'm really moving through this fast, but you know, we've got 2 speakers after me that I want to give them, and I want to give them some time. The other name I want to talk about is Petrobras. Petrobras has one of the most promising production growth outlooks in the integrated oil sector, and is our favorite name in the space. The company has cut net debt by 1/3, and we believe that reduced funding needs, if it executes on its asset sale program, along with an increasing focus on its low break-even pre-salt fields, should drive a reduction in leverage once fuel demand starts to recover. So as you can see from this chart, Petrobras intermediate notes trade about 200 basis points tighter than those of other several oil majors, including Exxon and Shell. Now, while this spread has narrowed considerably from the high of about, as high as 460 basis points back in March, it's still above the mid-February level prior to the collapse in crude oil prices and the onset of the pandemic. So as I mentioned, in addition to oil price and fuel demand recovery, successful execution of Petrobras' asset sales program could drive a tighter spread gap. Next slide. Thanks. Let's do a quick comparison with the LATAM and Canadian oil companies. As this chart shows, Petrobras trades well wide of Suncor and Cenovus. Now, certainly the Canadian producers face less sovereign risk, but they are also more reliant than their LATAM counterparts on exports to a U.S. market, where new government policies may reduce oil consumption. Export numbers, Canada exported 87% of its crude to the US over the past 12 months. Brazil and Colombia exported just 5% and 36% to the US respectively. So I would also add that the heavy oil produced by Suncor trades at a marked discount to Petrobras and Ecopetrol's lighter product. Next slide. Thanks. So the gap between Eco and Petrobras bonds is now tighter than its pre-pandemic level, about 85 basis points. So what are the catalysts that we think could drive a further tightening of the differential? First, a weaker Colombian economic outlook that drives an increased risk of a downgrade to high yield for Eco's credit ratings. I'll speak more on this later, and a successful execution of Petrobras asset sales. Next slide, please. A quick comparison to Pemex. I won't go into much of the details here, but what I did want to point out is, as you see the spreads between the two compress, it's the 28s. The 26s have already started compressing down to pre-pandemic levels. It's the 28s that we think will follow from this. So next slide, and my last one. Finally, I'd like to take a look at the sovereign ratings influence on these bonds. One of the reasons we like Petrobras is that its ratings are constrained rather than supported by those of Brazil. This is not the case with Pemex and Eco, both of whose investment grade ratings are supported by their respective sovereign ratings. This puts them at risk of a downgrade if the sovereigns are downgraded. So looking at this chart, you can see that Petrobras' long bond spread versus Brazil's sovereign bond has now tightened to below pre-pandemic levels. We think this is justified given the strength of the company and the prospect of further debt reduction. So again, I apologize for rushing through this. If there are any questions, please contact me, but I'll hand over to Steve Flynn.
Great, thank you, Jamin. Hi, my name is Steve Flynn. I'm a senior credit analyst for Bloomberg Intelligence with coverage of the communications sector, including telecom, cable, and media companies. I've been with BI for over 5 years now, and previous to this, I spent about 18 years at Morgan Stanley, where I ran our desk research analyst effort for high grade and high yield. The big topic of the day in the communications space is the C-band spectrum auction. So the C-band spectrum auction is undertaken by the FCC. This spectrum is perfect for 5G network deployment. So the demand has been very, very high, much higher than anticipated. So far, the bidding is up to $81 billion. Plus, they're going to pay another $13 to $15 billion to the satellite operators that are currently utilizing the spectrum. Part of that payment is for them to cost reimbursement for the cost to free up the spectrum. The rest of it is incentive payments for the satellite operators to exit the spectrum as quickly as possible. Next slide, please. So what's going to happen here is that the biggest borrowers are going to get even bigger. So heading into the C-band spectrum auction, the war chests for the main communications and cable providers that are bidding for the spectrum were very large. However, what we're realizing now as the bidding goes higher and higher is that they're not large enough. So what you're going to see is the largest borrowers in the IG market are going to get even bigger. So we're talking about AT&T, Comcast, Verizon. They're dominant players in the IG market, and they're going to get even bigger. AT&T just announced the other night that, or there's news the other night that the company's trying to line up a $14 billion delayed draw 1-year term loan to help fund their spectrum acquisitions. And I would expect for that to be refinanced in the IG market once the auction closes. So we're likely to see more and more issuance in the IG market and some issuance in the high yield market from the spectrum bidders. Next slide, please. So let's dig a little bit more into sort of impact on the leverage ratios. So here are some of the main players in the spectrum auction. The more they spend, the more the leverage will go up. Heading into the auction, Verizon was the best situated to spend a lot of money, given it had the lowest leverage ratio and one of the strongest balance sheets in the sector. The one with the most leverage and the least position to spend a lot would be Dish, which is a single B rated credit. Next slide, please. So let's focus a minute now on AT&T. AT&T is the largest non-financial borrower in the IG index. And the problem here is that AT&T is rated mid triple B. AT&T could spend $20 billion or more on the spectrum auction, which would push the rating agency adjusted leverage ratio, above 3.75 times, which is the threshold for downgrade for S&P and above the downgrade threshold for Moody's. So you're talking in this situation here where AT&T's credit profile is going to be worse than its ratings. And having AT&T be downgraded would be very dangerous for the overall corporate bond market, given how big they are. Now, the good news is that I think the rating agencies will be flexible. I think they will be patient. And I think AT&T may go above, the downgrade triggers, yet I think the agencies will give them time to repair. S&P released a note the other night that suggested such. And I guess we could potentially see a change in outlooks from stable to negative, but I think a downgrade is unlikely. Please remember that both AT&T each produce about $10 billion a year in free cash flow in excess of dividend payments. So they do have the cash to pay down the additional debt from the spectrum auction. It'll take them a few years to do it, but they do have the capacity to do it. Next slide, please. So what about AT&T bonds? So AT&T, was underperforming year to date. Part of that is risk of the higher leverage from the C-band spectrum auction. The other part really is just the shape of AT&T's debt curve. AT&T has a ton of long-dated bonds, a lot of duration here. So in a rising rate environment, you're going to see AT&T underperform. That's what's happening. I do think that AT&T will maintain its credit ratings, and I do think that AT&T can repair its balance sheet over time with free cash flow. And there's always the potential upside catalyst of an asset sale. It's been reported in the news several times over the past several months that AT&T is looking to shed about half of their stake in their DirecTV subsidiary. There's a possibility they could extract around $11 billion from that business by putting about $7-8 billion of debt on it and selling 50% of the equity for about $4 billion or so. That's what's been reported. And so that is one way for them to extract cash and help repair their balance sheet after the C-band spectrum auction. So that could be a positive catalyst out there for AT&T. Next slide, please. Next, I would like to talk a little bit about Verizon. So Verizon is an interesting story here. So Verizon has been on the cusp of return to single A credit ratings for many years. A good 10 years ago, the company lost its single A credit ratings because it's levered up to buy out Vodafone from Verizon Wireless. Vodafone owned about 45% of Verizon Wireless. Verizon levered up, bought them out, was downgraded, and they've been trying to repair the balance sheet ever since. Now, it's funny, right now we have another situation where Verizon is considered to be the largest bidder in the C-band spectrum auction. Is going to make a massive investment here, and this is going to potentially keep them from achieving their goal for another couple of years, right? So Verizon was just on the cusp of the rating agency leverage metrics trigger for an upgrade. They're very, very close to have rating agency leverage of about 2.5 times, which is, the cutoff point, but they're going to take a few steps back here with a potentially massive investment in C-band spectrum licenses. Next slide, please. Now, the Verizon bonds have paid the price here too. Verizon bonds have widened. If we went back a few months ago when they seemed to be on the cusp of an upgrade to single A, the Verizon bonds traded right on top of Comcast's A3, A- rated bonds. However, Verizon has widened out here. And again, like AT&T, I think Verizon, has the ability to repair their balance sheet. They have the free cash flow. They're very concerned about having a strong balance sheet and very concerned about improving their debt rating. So I think Verizon bonds are interesting now that they've widened out here. Next slide, please. So what's one good thing about spending a ton of money on spectrum licenses? You couldn't find a better time to borrow money, right? Cost of money is next to nothing. Rates are low, markets are open. Now's the time to issue debt. So the one great thing for these companies is the ability to get capital to pay for these licenses is there. For example, T-Mobile earlier this week issued some unsecured bonds. They have junk-rated unsecured bonds. They issued $3 billion of paper with 2 handle coupons, right? So the longest dated coupon, 2 7/8 coupon, high yield, 2 handle. Sounds like an oxymoron, but that's where we are. And T-Mobile is taking full advantage of that. Next slide, please. Just also want to touch about the cable companies, right? So Charter and Comcast formed a joint venture that's participating in the C-band spectrum auction. So you could see them spend, $10 billion each or so, $5 to $10 billion each. You could see their leverage jump up. Comcast has been very focused on reducing the leverage since the leveraging acquisition of Sky a couple of years ago. The company has a lot of liquidity, has done a good job, and I think they're going to invest a fair amount of capital here in the C-band spectrum auction. Next slide, please. The biggest impact may be a change in capital allocation. So if you take a look at a company like Charter, Charter has been a huge buyer of its own shares. Over the past 4 years, the company has purchased about $35 billion of their shares, $35 billion. So what we could see here is a slowdown in that, and they could see them utilize their free cash flow to pay for the spectrum licenses. Next slide, please. And with that, I'd like to pass it over to my colleague, Rob Schiffman. Rob?
Thanks, Steve. I appreciate you shaving off 12 seconds off your presentation to giving me a little extra time. Hi, everyone. I'm Rob Schiffman. I cover global tech and internet credits for BI. The good news is I'll be the last scheduled speaker, and there's only about 2 minutes left in our time. The bad news is at the conclusion, the cocktail party this year is going to be in Westchester, but rest assured, I've got plenty of bubbly here for everyone. I'm going to talk about Dell. Again, I can make this fast. I believe Dell may potentially be the best performing IG tech name in both cash and CDS in 2021. There's a combination of both deleveraging and event reward that could lead to rating upgrades and IG ratings across the board. And even though we've seen a considerable rally since April, again, in both cash and CDS, I think there's a tremendous opportunity for additional spread compression over the next 9 to 12 months. And go on to the next slide. For those of you who do know this credit very well, this might be pretty boring because we've been talking about this for 5 years. But for those of you who don't, Dell is one of the largest tech credits in the world. They've got over 90 billion of revenues, 12 billion of EBITDA, and about 9 billion of free cash flow. They're diversified across businesses from hybrid cloud solutions to PCs to servers, storage, and software. They're pretty much number one in every business that they're in. And if they're not number one, they're ranked in the top third. The real problem with Dell is the right-hand side of their balance sheet. They've got over $50 billion of debt, and they're probably one of both the most loved and most hated credits in my universe. You have to remember in 2013, they did an MBO for $25 billion, and then they re-levered in 2016 to buy EMC for almost $70 billion. Next slide, please. If we look at 2020 from an operational perspective, it's actually been a great year. If you go back to March when pandemic woes were at their highest, no one could have envisioned that Dell's performance would have been this strong. But whether it's cash from operations or EBITDA or free cash flow, or even the backlog of business that they have from a fundamental standpoint, the story has held up very well. Next slide. One of the things that we highlighted earlier is the tremendous value of the terminal. And we have a checklist for every one of our names, and we highlight red, yellow, or green for a variety of different categories. And similar to Ira's charts, if you click into this, there'll probably be 100 different Excel-dominated macros that will give you more detail than you could have ever imagined. One of the things that we try to do, though, with our colors is to give you a very quick glance of what our view of the credit is. And you can see with the name dominating greens, you could see that we're positive. We'll move on to the next slide. The story here really is all about deleveraging. This is one of the few companies that's publicly committed to prioritizing bondholders over shareholders. They're obviously doing it because in the end, it will help boost the stock price, but they know they're over levered. They know they need to pay debt down. They've committed to doing that, And they've actually not just talked the talk, but they've walked the walk. You could see since the EMC closed, they've paid down over $17 billion of debt. They still have a ways to go. One of the things that they've benefited from is that EBITDA has also climbed. So leverage is now below, from a core basis, below 3 times and inside S&P's targets for investment grade ratings. I'm gonna go to the next slide. This is a very complex structure, and one of the reasons why it trades so wide is not just what Steve mentioned about some of his communications bonds, where there's a ton of them and they're long duration, but the structure of having secured investment grade bonds, unsecured high yield bonds, subordinated high yield bonds, secured bank loans, it makes it very difficult for when people ask, what is this name even rated? And when you have that level of complexity, you know, you're going to get paid a little bit of more incremental yield. The benefit is the company wants to be investment grade at the parent level. And if they can get that done, bonds might not be pari passu, but if everything is rated investment grade, it becomes a lot easier to understand. And certainly, if you go from a capital structure that has a host of BB rated bonds to only BBB rated, you know, spreads are going to go a lot tighter too. The rating agencies have noted this. Management continues to note about debt paydown. One of the biggest catalysts that we see is that in the second half of the year, there's a potential for Dell to spin off its largest asset, VMware. And as part of that spinoff, I think they can reduce core debt by about 50%. That would be through a $15 billion goodbye dividend. I think that would immediately take Dell to investment grade and drive spreads dramatically tighter. We can go to the next slide. Listen, the last couple things to mention, you know, part of the reason why this name can outperform is because they trade so wide, and it doesn't make a difference if it's the long end of the curve, the belly of the curve, or in CDS. Dell trades in cash somewhere between 50 and 200 basis points wide to everything else in the tech universe. Next slide, please. And the same can be said still somewhat in CDS. There you go. There you go. In CDS, the names rallied a significant amount, but if you were to get upgraded and you're BBB across the board, I think you're going to trade closer to names like Charter or AT&T, and that could mean, you know, 50 plus basis points in spread tightening. And the last thing is simply there's unique bond features here. You know, Dell's investment grade bonds, they're not just secured. They've got coupon step-ups, they've got one-on-one change of controls, they've got first priority liens, and they've got subsidiary guarantees. This is unlike any other bond that exists. There are other secured investment grade bonds like Charters. They don't have the same structural features as Dell. So with that, I'm going to turn it back over to Joel to handle Q&A if anyone's still around.
All right, thanks, Rob. And luckily, we can't say buy, sell, or hold, but we can just give our views. I think we've addressed most of the questions offline. So let me just point to 3 things. One, since I didn't get a turn to make my picks, I'll just put on my GM hat and leave it at that. 2, all of the slides are available. They'll be on the FIASI website if you're a FIASI member. Alternatively, if you're not or have difficulty, feel free to reach out to me and we'll get you a copy of them either late today or tomorrow. And 3, all of the functionality and data and research that you saw today and heard are all available on the terminal. And as Noel pointed out earlier, we're always available for one-on-one discussions. Feel free to IB, email, or just phone call us, and we're more than happy to help. So that, let me thank the FIASI staff, including Ralph and Lauren, and that's it from us. Ralph?
Thanks, Joel. I'd like to thank all the panelists, Bloomberg Intelligence. Thank you, everyone, for attending today's webinar. If you have any other questions, please contact Lauren Nauser at nauser@fiasi.org, N-A-U-S-E-R. Once you leave the webinar, there will be a survey. Please fill it out. And we appreciate your feedback. You also get a follow-up email in the next 2 days. On behalf of FIASI and Bloomberg Intelligence, thank you everybody for joining and have a good day.